Every deal has two ingredients: a strong opportunity and the money to back it. Most people think finding deals is the hard part, but here's the truth. Raising capital is just as important. If you can raise capital, you can close bigger deals, move faster, and scale your wealth dramatically. Today, I'm going to break down how professionals raise capital for real estate and business acquisitions, and how you can do the same inside your solo family office. We'll talk about equity, debt, investor psychology, structuring co-investments, and even the exact pitch you need to give investors confidence. Capital raising sounds intimidating, but here's the reality. You're not begging for money. You're offering people an opportunity. Investors, especially high-income professionals, family offices, or entrepreneurs, are looking for good homes for their capital. They're tired of low-yield bonds, volatile stocks, or money just sitting in the bank. Your job is to give them a structured way to put their money to work, with strong downside protection and clear upside. That's capital raising. Every deal has what's called a capital stack. It's just the layers of money that fund the deal. At the bottom, you usually have senior debt, a bank loan, SBA financing, or commercial mortgage. This is the cheapest money, but it comes with covenants and obligations. Above that, you might have mezzanine debt or preferred equity. More expensive, but flexible. And at the top, you have common equity, the cash investors put in. That's the riskiest capital, but also the one with the most upside. When you raise capital, you're usually raising the equity portion of the stack. That could mean LP equity from investors, GP equity, your own skin in the game, or sometimes structured co-investments from other sponsors. The magic is putting these layers together in a way that protects downside and amplifies upside. Here's what I've learned raising capital for real estate and business deals. People invest in three things, in this order. You, do they trust you? Do you sound competent and credible and confident? The deal, is the opportunity clear? Does it make sense on paper? And does it match their goals? And thirdly, the structure. Do they understand how they get paid and how their capital is protected? If they don't believe in you, the deal doesn't matter. If they believe in you, but the deal looks sloppy, they'll pass. You need all three. Let me give you a simple framework for talking to investors. I call it the 3 C's. Clarity. Show them the numbers in plain English. Cash in, cash out, timeline. Confidence. Speak with certainty, but don't oversell. Investors can smell hype a mile away. And conviction. Show that you're personally committed. Skin in the game. GP capital contribution, your own time and reputation. For example, when I pitch a deal, I'll say, we're buying a $10 million shopping center at an 8% cap. We're putting in $3 million of equity, of which I'm contributing $150K myself. Investors get an 8% preferred return and 70% of profits after that. Our business plan is to renovate, re-tenant, and sell in 5 years for around $15 million. That creates roughly $5 million of value, of which 70% flows back to LPs. Here's the underwriting. No fluff, just clarity, confidence, conviction. As a GP, the general partner, your role in capital raising is to set up the entity structure, the LLC operating agreement, contribute your own money, 5 to 10% of the total equity, create the pitch deck and underwriting model, build the investor list and manage relationships, communicate transparently with investors throughout the whole period. This is where amateurs fail. They think capital raising is a one-time thing. It's not. It's a relationship business. If you treat investors right, they'll come back deal after deal. In real estate, you're raising capital against tangible assets, building, leases, NOI. In businesses, you're raising capital against operations, cash flow, and growth potential. But the principles are the same. Protect investor downside. Share upside fairly. Be crystal clear about risks and rewards. In both cases, your solo family office acts as the sponsor, pulling together capital from different sources and structuring it in a way that makes the deal work. So here's the takeaway. Capital raising is a skill. It's not about begging. It's about showing people a clear path to put their money to work in assets that produce cash flow and equity. If you can master raising capital, you'll never be limited by your own checkbook again. You'll be able to take down bigger deals, scale faster, and build real wealth. And if you want help building your solo family office, if you want me by your side, not just underwriting deals, but structuring them and raising capital the right way, there's a link in the description. Book a call with me and we'll see if it makes sense to work together. Because the truth is, money is everywhere. It's abundant. But smart operators who can structure deals and raise capital the right way, that's rare. And that's exactly what I'll help you become.